Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. This video is a summary of my May 12th report. In this report, I discuss why companies, these are exploration and energy companies that are traded on the New York Stock Exchange, may be giving us a very powerful signal that the price of natural gas may not be staying under $2 much longer, and in fact could easily be approaching $4 by the end of the year. In previous reports, I discussed that natural gas typically makes lows and shoulder periods. The shoulder periods are either in the spring, when the demand for gas and electricity is low between the summer cooling and winter heating seasons, or in the fall, when the price is low again between the summer cooling and the winter heating season. Also, historically, we have seen very important lows being formed during these shoulder periods, and I believe this year is no exception. In fact, the lows we're seeing in natural gas in this year's spring shoulder period are the lowest inflation-adjusted pricing for natural gas we've seen since it began trading in 1990. Now, these prices are unsustainable because they're below the cost of production. Weaker companies are going to go out of business, and the larger companies are going to be highly motivated to decrease production so the price will go up. Now, the question is, are we seeing evidence of that? And I believe that is absolutely the case. And the evidence that production is now decreasing and companies are decreasing their levels of production is reflected by the Baker Hughes reports that come out every Friday. In fact, over the last 6 weeks, we've seen a significant decline in active oil and gas rigs. The oil rigs have declined over the last 6 weeks from 624 rigs to 292. This is a decline of 53.2% and 63.7% year over year. And year over year, natural gas active rigs have declined from 183 to just 80 active rigs right now, which is down 56.3% year over year. Now, the question is, in the past, how has natural gas traded when it declined to near present price levels and production declined? Over the last 20 years, as you can see in this chart, natural gas was only below $2 3 times. And as you can see, the average price was always much higher for at least 3 years. Now, today's report will focus on additional evidence supporting why I believe natural gas will increase significantly from present levels. And this is based on the Exchange Traded Fund, FCG. FCG seeks investments corresponding to the ISE Revere Natural Gas Index, which tracks companies deriving revenue from the exploration and production of natural gas. Now, simply put, this index is a basket of exploration and production companies of natural gas. Now, keep in mind, the stock market is forward-looking, and the price of any stock is based on future expected earnings. If the stock market believes that a company's future is not bright because earnings are not going to increase, then the price is not going to go up. But if the stock market believes that earnings are about to increase and these companies are going to become profitable, then this index is going to rally. Now, a clear example of this happening took place in 2016, the last time that natural gas's price dropped below $2. Now, let's look at 2 charts that I think will really give you a good picture of what's taking place. In the first chart, you can see natural gas's low was not reached until March 4th at $1.61. But by the end of the year, it approached $4. But as you can see in the second chart, stocks and companies deriving revenue from the exploration and production of natural gas started to rally January 20th, which was 6 weeks prior to natural gas's March 4th low. As I said earlier, natural gas exploration and production companies are not profitable with prices below $3. Therefore, in 2016, those who started buying exploration and production companies on January 20th believed natural gas would not remain under $3. And as you can see, they were right, with natural gas approaching $4 by the end of the year. Now, the question is, are we seeing something similar happening this year? To find the answer, let's look at 2 more charts. Consolidation patterns form when traders are positioning themselves for long-term moves. And the longer it takes for the pattern to form, the higher the following move. This is especially true when the consolidation pattern is formed at a historically very low price level like we are today. As you can see in the first chart, after a false breakout last week, natural gas pulled back into the consolidation pattern it's been forming since the middle of January, which is an extremely long period of consolidation. The question is, Are the companies deriving revenue from the exploration and production of natural gas telling us natural gas is preparing to move significantly above $3 per million BTU, which is where it needs to be for them to be profitable? The answer could be found in the second chart. Apparently, as in 2016, those buying stocks in companies deriving revenue from the production of natural gas believe natural gas prices will not remain under $2 very long, but are destined to rally significantly above $3 and become profitable again. Over many years of trading, I've learned that past performance does not guarantee future results. But I believe, based on the information I've given you in this report, you'll understand that the price of natural gas is likely to be much higher on average for at least the next 3 years. I do believe that if you delay any longer, it could be very costly to you. In fact, the longer you delay, the more you very likely are going to have to pay in the future. I hope that this video has been helpful for you to see the wisdom in locking in these very low rates today. And until my next report, please take care.